Brian, good morning to you. Before we get to the week ahead, did anything fundamental for any of the big cap tech names change last week?
Hey, good morning. Thanks for having me. I would say a few things stand out that are notable. The first thing is, generally speaking, across all the space, the consumer continues to hold up for now. You know, Amazon is still seeing very robust demand, no real sign of weakness in the advertising markets, which are very predicated on strength in e-commerce. So first punchline is the consumer for now is still holding up quite well, which is important for the whole space. Other than that, there are certain idiosyncratic factors. So I would say on Meta and Facebook, they are actually making more progress on driving engagement of their new Reels product, which we think is important for the long-term monetization and sort of turning the narrative on that asset. So we like the progress that Meta is making a lot around Reels. And then on Amazon, I think the punchline is they overbuilt and they overhired, and it is going to take a little longer for all the profits to come through that we thought were going to come through post shelter in and reopening. They added the equivalent of the same amount of capacity in the last 24 months as they've added in the past 25 years. Yeah. And now they have to grow into that. And so we don't think anything has changed fundamentally about Amazon's e-commerce business, how to think about growth, how to think about the long-term unit economics. But the time in which it's going to take to grow into this capacity is going to take longer, which probably means that outperformance for this name is probably going to take another 3 to 6 months down the road.
Right, but the loss just over the last week has been staggering for a company of this size, nearly 17%. And, you know, there's been a lot of discussion. If you value Amazon where it is now, you're essentially valuing its non-AWS, non-cloud business at almost zero. On the other hand, though, and this is a point brought up by my .com colleague, Ari Levy, this is a 28-year-old company that has a negative operating margin.
Yeah, no, that's correct. I mean, I think, you know, the company goes into the penalty box because there's now questions about the long-term unit economics of retail, which still do matter to really making this a strong stock for the next 12 to 24 months. I look at total valuation, company-wide valuation, know some of the parts, and you say, well, the long-term average multiple on Amazon is about 20 to 21 times forward EBITDA. It's now down to 12 times that. And so even if you don't want to talk about some of the parts, even if you just say, let's say you can even get to close half of that gap from 12 to 20 on the multiple, as you prove the retail business still has the unit economics we all hope it can, there's a lot of upside in the name when you have patience for investors.
Brian, let's talk about these gig economy, ride hailing, and I would call them last mile companies in a way. So Uber, Lyft, DoorDash. There's this weird thing happening where the inflationary environment type labor market has made Uber and Lyft really pretty expensive right now. DoorDash is in this interesting position where, yeah, of course it's also expensive, but it's got Dash Pass as well. And it's kind of making this move to be a marketing vehicle, even for consumers who want to pick up from store, perhaps. So of those names, which do you think is most inflation protected and most labor market protected?
It's a good question. I think it's Uber just because of the rides side of the business. You know, we think that the elasticity around rides is likely to be lower than the elasticity around eats, but there is an impact on both. Now, in the near term, as we go into the back half of this week and look to the rest of the year, we think that between the reopening of the world, people going back out, people traveling, people coming back to work, even at more at smaller percentages than previously, I think the rides business can really snap back much more than appreciated. And the rides business, because we think the unit economics there are quite strong, we think it's actually the rideshare industry is a piece that the market is not giving Uber or candidly even Lyft credit for when we think about the free cash flow that can be generated over the next couple of years. So we think rides has more protection from inflation than the eats business does.